Okay, we should be underway. Well, welcome everybody to the Investing Roundtable for June 2019. This is the last session that we will do in our 8th year because we are 9 years old a month from now. We'll be celebrating our birthday a month from now, and we've been doing this monthly for almost 9 years now and thoroughly enjoying it. My name is Mark Robertson. I am founder and managing partner of Manifest Investing and a volunteer here helping out the Mid-Michigan chapter of Better Investing, the National Association of Investors. I'm joined here by my dear friends, Cy Lynch from Atlanta. Say hello, Cy.
Hello, Cy.
And he's got the wisdom tag on the page. He seems to like that. He wears it well. We're also joined by our dear friend from the central part of Michigan, Ken Kavula. Good evening, Mr. Kavula.
Hi, Mark. Hi, friends. How are you doing tonight?
And that's Ken in that wistful looking skyward gaze, third from the left there. And our guest night tonight is Herb Lemkool from Traverse City, also known as God's Country, up in the northern eastern side of the lower peninsula of Michigan. And I suspect he's got
Northwest, Mark. Northwest.
Northwestern.
Northwest, excuse me. Yeah, well, both sides are good, but Northwest is really good. Herb is probably enjoying a wonderful sunset as he works with us here tonight.
Oh, it's absolutely gorgeous. And of course, you know, this next week is the start of the National Cherry Festival, and the Thunderbirds are in town and going to have a practice on Friday and the show on Saturday and Sunday.
Well, it sounds like we should be heading back up there, Ken.
Well, you know, I am heading back up there in just about a week and no, 2.5 weeks. So I'll be up there doing a wine tasting with my sister and her significant other, and we're going to hit all the high spots in Traverse City and the Mission Peninsula, the Leelanau Peninsula, and just have ourselves one heck of a time, I hope.
Well, for those of you out there not familiar, as Herb knows, go ahead, Herb.
Yeah, if you get a chance, we also have a horse show that's dressage horse show jumping, and they are bringing horses from Florida and from Europe and everything else, and they have a huge purse. That's going on for 6 weeks out there in Williamsburg at Flint Fields.
Well, you might get Susan Michelik on that one. I know she's big into that. Well, let's go ahead and get to investing, guys. We probably better roll on. Let's get the legal paperwork out of the way first. We are going to talk about specific companies here tonight. No investment recommendation is intended. This is all about education. It's about a demonstration or an illustration of the philosophies and analytical techniques championed by the modern investment club movement as done by investment clubs and individual investors with the National Association or Better Investing or the community that hangs out at places like Manifest Investing. So again, it's all for illustration only. Please do your own homework. We could even own a company that we talk about tonight. We attempt to let people know about that. If you would like to have a family or a family member or a friend receive email reminders of these sessions, we do not just these once a month, but we throw in an occasional educational session. Just drop nkavula1 at comcast.net a note, and Natalie, that's Ken's significantly better other half, she will take care of you. She will not inundate you with email. She will simply remind you when we are doing this kind of stuff. If you are bashful or want copies of the slides or just want to do follow-up Q&A, my email address is markr@manifestinvesting.com. So with that, our standing agenda, again, welcome, especially if you're joining us for the first time. We do try to keep this fairly informal. We do try to keep it at just over an hour with an open period at the end. And again, welcome. We've been doing this for a while. We'll talk a little bit more about the details. We do keep track of our performance. We do demonstrate kind of a cursory shot, although it's getting more refined as we keep going along on portfolio management type concepts. And we'll talk about that from time to time. There are 4 stocks to be presented tonight. You see the tickers presented there. We do poll the audience at the end and ask you to choose from among the 4 or none of the above. And then, like we said, Ken was saying a few minutes ago in the green room, which, by the way, is something else that I don't know of any other webcast that does that, Ken, by the way. It probably confuses a few people where we're rambling on beforehand, but I think it's pretty cool. We will keep the floor open for Q&A for a while. We've been doing this for, again, 8.92 years. Just basically here to share ideas. The four of us will be laying out an idea, showing the way that we in the Modern Investment Club movement take a look at an opportunity, and we basically keep track of what we bring every month. The stocks that are picked are actually put into a tracking portfolio. Our long-term objective is to beat the market by 5 percentage points. We measure the market by the Wilshire 5000, and we do like to see over half of our selections actually beat a mirroring tracking investment in the Wilshire 5000. So it really is, we come here with the intent of sharing ideas and comparing notes. Here is a look at the performance. Again, over the last almost 9 years now, we are beating the market by 5.5 percentage points. If you look at the actual absolute rate of return since inception for the tracking portfolio, it's 16.8%. That ain't bad. That's actually doing pretty good versus a Wilshire 5000 checking in at about 11%. And about half the selections have actually outperformed the market. And you can see that it's been a nice steady climb. Most of the clubs in the Modern Investment Club movement basically target beating the market by 5 percentage points. So hence you see the relative return on the y-axis. Anything above 0 would mean that you're beating the market. The target is that red dotted line, and boy, do we like it when we get up around that line or above it. Any comments or questions, Ken?
Well, just except to remind everybody that if you're not quite to that dotted red line, but you're still above that 0 point, you're doing what an awful lot of investors find very difficult to do, and that's beating the market. And if you can do it only by 2 or 3, only I say, if you can beat the market by 2 or 3 or 4 points, that's significant. It's a significant boost to your nest egg and to your retirement accounts and everything else. The goal is great. The 5% goal is wonderful, and I love to see us above that goal, but it's not small potatoes to come into this area between 0 and 5 either.
No, and in fact, I had breakfast today with Don Danko and his lovely wife, Nancy. Don used to be the editor of Better Investing Magazine. Nancy was the bits lady, some of you who remember those days. And Don would actually defend even coming in slightly below 0. And his defense would be, it's so much better than stuffing a mattress, plus you're giving yourself an opportunity to do the other stuff. So, he was always defining, that's not failure either. If you're, at or near market performance, just keep pressing on, keep searching for incremental improvements, and never stop trying. And that's his
Mark,
message.
We have a hand in the air. Jacques has his hand in the air, and I'm going to unmute him. And maybe we don't have a hand in the air. It just went down, Mark. So that was an inadvertent hand. Okay. So let's keep going.
In that case, we'll keep pressing on. Go ahead, Cy.
I was just going to chime in for a moment there too. I think Don could have an interesting point about slightly under the 0 for a number of reasons, but I'll leave that to him himself. But to just again reiterate what Ken said, if you are talking 20, 30, 40 years, which some of us on this call may not have the 40 or 50-year time horizon anymore, but hopefully when you start out, many people do, even 1% is a huge difference in what you have. And this is comparing, right now, so much of the rage, and I certainly think it's better than stuffing a mattress, but so much of the rage is index investing, which by definition means you do the market. So again, if you even 1 or 2% over, certainly a 10-year time frame and longer can make a tremendous difference in your total portfolio.
Absolutely. In fact, that was some of the hot air I was spewing in South Carolina this weekend, Cy. And we're going to actually cover a little bit on Joel Greenblatt later, and he's a very accomplished investor that he achieved quite a few rungs of that ladder of better performance over time. All right, so let's go ahead and take a look at this. Is the top 20 by dollar value or percent of total assets in the tracking portfolio. There's about 70, I think, stocks in the tracking portfolio. If you want to see all of the positions, you can go to that link up at the top of the page. That's a public link. You can visit it without us even knowing you're there, but you can actually see all of the holdings. What we do is we take every time a stock is selected by a knight, a damsel, or the audience, we invest $1,000 into it. So in the case of Microsoft, which is our current leader in terms of dollar value, Microsoft has been selected 5 times. So $5,000 invested in Microsoft is now worth $29,700. That's getting to be pretty special, and the kind of thing that we like to see. So again, this is the code with the legend. You can actually find the companies up here, figure out how many thousand are invested in the companies, and some of these numbers are starting to get pretty interesting. I know Amazon is a 2-time selection, just as an example. So $2,000 invested in Amazon is the 13,000 that you see there. So some fun stuff. Any comments or questions on these guys?
Well, I like to watch the averages at the bottom, Mark, and these are the averages for the entire portfolio. These averages do not just represent the 20 stocks that you see, but the portfolio is up, at over $400,000 now, with a par, a forward-looking par number, which is very respectable, right about at the market average that we were looking at for the Wilshire 5000. But I'd like to see that par boosted a little bit as we move forward. That means that you need to buy stocks with par values higher than 11.8, and maybe you need to sell stocks with par values that are less than that. Our quality and financial strength and EPS stability, I think those numbers are tremendously good. Just the goal would be to keep them there. And that sales number, remember, that means sales growth at 11.4%. We say that small companies tend to grow at 12 or better, so we're moving up very close to the growth rate of a small company for the entire portfolio. I think that 11.4 is quite respectable. I wouldn't mind nudging it up another couple of tenths, maybe to somewhere nearer to 12. But I think all in all, our numbers are pretty decent, especially for as old as this portfolio is and as many holdings as it has in it right now. If anything, I'm going to try to keep an eye myself on par value and try to move stocks into the portfolio that have pars that are a little bit better than that 11.5%, 12%. And maybe at some point we'll do some looking at ones near the bottom and moving them out a little bit because of valuation purposes.
Yeah, and that's a pretty good segue to the next slide, because the first thing we do is take a look at, of the companies in the tracking portfolio, which have the weakest or the lowest return forecasts. PAR stands for projected annual return, and a quick audit of Simulations Plus, it's not followed by very many analysts, and one of the analysts must have really changed their mind. I did a quick audit, and this number actually went up to about 10%, so that's not actually on the hot seat. And I would argue that none of these really, they're on the hot seat, but again, we're talking about returns of 4%, 5%, 6%, not exactly stocks that need to be jettisoned if they are truly high quality, pretty good companies. The average stock right now is at 9%. So
we have a question in the questions box, Mark, about Simulations Plus. Somebody wanted to know if it might be time to sell a stock with a par down at this particular level. I always like to take a look at the very last time that the data was refreshed before I sell a stock. So, Mark, do you know when the last time the Simulations Plus data was refreshed? I know that they go on 3-month cycles.
Yeah, it was actually a May update. So it is a little bit dated. And actually, I don't want to go too deep into the subject tonight, but we have been actively testing a new data source, which is basically going to, in fact, I'll be writing about this in the next couple of days. we will be moving to a continuously, constantly updating database, especially paying more attention to the smaller companies, not to the Value Line Standard Edition. We're going to continue to follow those just as we always have, but we are going to raise our focus and emphasis on the smaller companies, and they will literally be updating almost on a daily basis. So I can't wait till we get that fully in place. It's going to happen here fairly shortly.
Yeah, we have to make the point that we make on a continuing basis almost every single time we have a roundtable, that a low par does not necessarily mean a stock that's not performing well. In fact, many times, most of the time in my experience, a very low par indicates a stock that's been performing extremely well. It's been performing way past what you might expect, and that means it's gotten a little bit ahead of itself. Usually when a stock moves very quickly to the upside, when the price moves to the upside, then it kind of soaks out a little bit of the potential going forward, and you see the par drop in response to that quick upward price movement. The opposite's also true. When you see a stock whose price moves down in a very precipitous manner, many times you'll see the par move the exact opposite direction, which is up in the same kind of dramatic fashion. I'm not necessarily sure that either one of those are true reads on what's happening, but it's what happens with the arithmetic when prices move quite quickly.
Yeah, and I think we'll take some of that noise out of these situations. It can't do anything about stocks that are covered by one or two analysts that dramatically change their mind or wake up with the flu one day. But we'll see what we can do. So I wouldn't be quick to jettison any of these unless any of you guys want to take off your shoe and stomp on the table and demand that we get rid of any of these. I don't see it.
All I can say, Mark, is that I own Simulations Plus in 2 of the clubs I belong to, and it is on the agenda in both clubs for a review. That's just the first step along the way to maybe making a sale of it, but we are going to be reviewing Simulations Plus in both of the clubs that owns it. I've also noticed that a lot of the high flying portfolios in the groundhog competition contain Simulations Plus. In the top 20, I'll bet you 8 or 10 of those portfolios contain a holding of Simulations Plus, which has contributed dramatically to their ranking in that contest right now.
Yep. So let's let these ride. We can always party next month if they continue to soar. The second thing we watch for, and we've done quite a bit of research into this, quite a bit of discussion over the last year or so, for companies that are in their first 12 months from the time of selection, we watch for them to lag the market by 20%. We do not have any of those at this time. The worst offender right now is down around 12 or 14% behind the market. So we actually don't have any of those to talk about it tonight. The third condition that we've been monitoring for is companies where the quality has degraded a little bit. And Ken, this might be one for you to tackle editorially a little bit. United Therapeutics, nothing to panic about, but it has slipped in quality a little bit. What are your thoughts on this one?
Well, what this is, the graph looks a lot different, Mark, than the graphs on a lot of them that we used as examples when we started talking about this quality degradation idea. I noticed the quality dropping down there about 3 or 4 green bars in from the end. That's the blue line, by the way, folks. And usually what we were seeing when we saw this drop in quality was that the price kind of lagged that drop. But this price seems to be dropping right along with the quality. So I'm not sure whether we have the opportunity to move in like we did on some of our other stocks, where we were given the luxury of a 2 or 3 month gap before the price seemed to follow the quality down. With that being said, I'm not comfortable when the quality drops like that. I don't know whether it's due to balance sheet or whether it's due to debt or what it's due to, but when a quality drops that looks to be about a 7 or 8 point drop, that is something that is quite concerning from my point of view.
I think I have a recommendation, and that would be that we just kind of watch it, and I'll put an alert in to catch it and flag it if it actually drops or breaks 60, and then we basically rake it across the coals if it does do that. The 60 would be kind of like the low point on this 4-year chart.
Okay. Mark, we do have a hand in the air from Margot. Margot, you're unmuted. Go ahead. Margot, I can't unmute you because you're muted by yourself on your machine. You'll need, there we go. So go ahead, Margot.
How do you measure quality?
Okay, it's probably a 60-minute talk, but we'll give you the 30-second version. Our definition of quality is based on the definition as promulgated by George Nicholson, founder of the Investment Club movement, and Benjamin Graham, the guy who taught Warren Buffett how to invest. There's 4 main components. The first is the financial strength of the company. The second is the earnings stability, the earnings predictability of a company, the straightness of the lines on the stock selection guide. And then for every company, we compare their projected growth rate and their projected profitability versus their peers and competitors. Then we add that all up and basically measure all 2,500 companies the same way. If you want to dig into the deeper definition, if you Google manifest investing and use the word excellence, not the word quality because you get a million hits, but use the word excellence, you'll actually be taken to the recipe and the definition of what we're talking about here. All you're seeing here on this chronicle is a month by month. We actually say EKG, quality EKG on this picture. Okay.
I'll just make one quick passing comment on United Therapeutics. I do not own it, so I don't follow it, although it is in my Better Investing growth stocks tracking portfolio as well, and I believe I've presented it here as well. But I just did a quick look, Ken, because I observed the same thing. It looked like price was kind of going with the quality, although if you look at that first drop and you had acted immediately, we might have saved a little bit of the last month or so of drop. But at least I haven't looked at it over time, but right now the big hit on quality, and it may explain why the price dropped so drastically, is the sales growth, is the component of quality. Mark just mentioned the 4 components of quality, and of course to have average quality you would have a 12.5 in each of those components. The component for sales growth is only about 3%. So there's something, I suspect there was a major sales growth shift.
Okay. Well, again, that's part of diagnosing what's going on with these guys. But we will be watching them a little bit closer, and we will certainly flag them if they drop below 60 for sure. All right. And one last thing, I don't want to go into this one in much detail at all, other than to promise that we are continuing to monitor Cognizant. There's a hour-long session on this topic. If you want, send me a note. I'd be happy to send it to that. We're just simply pointing out that this did have a gap down fairly significantly, and Ken sent me a note earlier this week asking me if that gap was filling, and that kind of has been happening here over the last several days. So there's a couple of things there. We would not be surprised if Cognizant's stock price was kind of stuck around 62, 63 for a while, or even kind of settled back down into that 60 range for a while, because the institutional traders kind of have it in their crosshairs. The other thing that we point out is that relative strength index did dip down to 20, which is kind of a multi-year buying opportunity when it was down around 58, 59. I think I'd be very tempted to own this company if it got back down there again. So again, it will fill that gap at some point and could possibly take off, especially if the short-term moving average takes out the long, in other words, the red crossing that blue line and staying crossed. And then just a quick note that the types of things that we're talking about here, these death crosses and golden crosses, this is a 20-year daily chart for Cognizant. Only reason we do this is to show that the type of thing we're talking about watching for here has only happened 4 or 5 times over a 20-year period. And we appear to be in one of those situations where we're headed for another golden cross. We actually are on the heels of a serious buy signal when the relative strength got down below 20 not too long ago on that price dip. And we are watching this type of an indicator pretty closely to see what type of thing it might tell us about some of our stocks going forward. So again, that's covered in much greater detail in a Cognizant Nation post at Manifest. And if you'd like to see more about that, just send me a note, markr@manifestinvesting.com. All right, and with that, we are through with our first segment, and I think we'll go straight into our stock selections. This one's a cool one. Ken, I thought you were going to mention more about it being one of our favorite small company stocks for a bit, but
well, it's no longer a small company, Mark, and that's why I'm kind of veering away from talking about it as a small company. But I agonized this particular month for picking my stock. I had made two different choices, and in fact, I had actually told Mark my second choice, and then I surprised him this morning with a completely new choice. I'm having some difficulty coming up with stocks that I feel have a good solid basis and fit our model and are moving in the direction I want to see them move. And I feel that I found one with Forward Air here. I should let you know that I do own this stock. My wife owns it in her IRA. So let's take a look at Forward Air and see what it does. Next slide, Mark, okay? If you're been around for a while, you've heard this name off and on, and they basically were known for the last 38 years for dealing with airport-to-airport experiences. In other words, getting material, getting packages, getting items, getting stuff from one airport to another airport, and that involved expedited services, scheduling, very tight time windows to meet plane schedules, a lot of premium handling of materials, a lot of very specialized materials, and a very asset-light model, which means that they don't own the airports, they don't own the planes, they don't own a lot of the trucks that bring the materials to the airports, but rather they contract for those things. Well, in the last couple of years, Forward Air has begun to expand into completely new areas. Next slide, Mark. And besides doing the airport-to-airport stuff, they've been working now with LTL pickup and delivery. I'll tell you, as going through this investor's presentation from Forward Air, I learned more acronyms than I ever want to keep track of. So I'm referring to my notes here. LTL is less than truckload. So you're picking something up that doesn't fill the truck up completely from the airport, and now you're going to take it somewhere. They're also delivering the final mile. The final mile is a lot different to deliver to than you might find delivering to a business or something. It many times involves roads that have very strict speed limits. It very many times involve roads that are a lot smaller, that have load limits applied to them, and many times it involves roads that aren't even paved. So going the final mile is a whole new area for this particular company. Intermodal drayage. Intermodal means that they're going to use a lot of different tools to get their stuff, and that's a very technical term, stuff, to get their stuff from one place to the other. They might use containers, they might use railroads, they might use shipping, they might use trucks, they might use airlines, but they're going to use whatever they need to use to get from one place to another. And they're now dealing big time with the expediting. That means all the scheduling that goes into all this trucking, telling the drivers when to be at a certain location, what to pick up, and then where they're going next and what they're going to drop off. We're also talking about pool distribution, which means that they are not afraid to work with other companies in coordinating pickups and deliveries of materials. Next slide, Mark. Notice that Forward Air has a pretty heavy-duty footprint to the east of the Mississippi, and the dots get a little bit sparser as you move to the west coast. So the first place that Forward Air makes the point is they have lots of room to grow, and they are doing significant growing in the southeast, in the central south, and in the western portion of the US. And then they're growing out their business in places where they don't right now have some of the services. Not all of their offices have all of the services that I spoke about, but the goal would be eventually to have these offices that covered all of the different things down the right-hand side of this slide at every single office in the country. Forward Air is looking to become a major player in this delivery and expedited trucking in the country. For the moment, they plan to stay within the country, although they do have offices and they do move through Quebec and parts of Ontario. Next slide. Their business model basically is pretty simple to understand. You can read it, and I would focus on the third point, that they are an asset-light company. They utilize independent owner-operators of trucks and third-party carriers. That gives them a lot of cash flow to finance expansion and to finance other modes of running the business and creating new opportunities for their business. Next slide. You can see and there's another one of those acronyms, TAM is the total addressable market. So, and that first line, expediting LTL, that's less than truckload shipping, they get revenue of about 756 million, and the total addressable market's about 5.5 billion. That's the way you read this particular chart. And you go all the way down to 3 lines from the top, and you see the current company is $1.3 billion in revenue out of a total addressable market of about $19.5 billion. They just recently closed a large acquisition. They bought FSA Logistics, another similar type of company, and that brings their revenues then to $1.4 billion and the total addressable market of 26.3 billion. So right now they're only covering about 5.5% of the total addressable market. Lots of room for growth. Next slide. Their slogan is, when it's bigger than a box, we've got you covered. And they're doing a lot of this less than truckload, this intermodal kind of thing, and this adjacent modes where they're going from one place to another by different types of transportation. Next slide. Here's the chronicle for Forward Air, and I'm seeing a quality that kind of minimized itself at around 80 back in the end of 2017, and has been on a pretty steady upward climb ever since. I always like to buy a company when the quality is moving upward. The end points on these graphs, the blue line, which is quality, and the red line, which is par, the end point values occurred at the very end of the month of May, and that was a par value of 14.6 and a quality of 93.5. The high par values, which you see back in around 2015 or so, those high par values in there were around 17. I like to buy a stock when the par value is approaching a 2 or 3 or 4 or 5 year high. So I'm looking very closely at that 14.6, which was at the end of the year, which looked like the high value all the way from maybe 2016 to today. And I'd also looking at those 17 par values, which were occurring back about 4.5–5 years ago. Next slide. Value Line thinks revenues for this company will grow at about 10.5% and earnings at about 12%. That's certainly good, steady, solid growth for this. And, you know, you have to put it in my mind somewhere as a very, very large, small company or a very, very small, medium-sized company. But why quibble over the words? Those numbers are really pretty decent. If I look at the mini industry study that is provided in Manifest Investing, I find out that Forward Air competes with companies like J.B. Hunt, UPS, Expeditors International, FDX, and of the five, Forward Air seems to have the greatest potential at the moment. The numbers coming into Mark's data coming from the analyst throughout the country are showing Forward Air to have a par about 15.5. That's certainly higher than it was at the end of the last month, the end of May. And I like the number. Today, par is sitting at 15.4, as I said, with a quality of around 96. Let's see how that compares with my SSG. I'm looking at Mark's numbers coming from the analyst community. They're pegging sales growth at about 10.5. They're pegging average PE of around 18. I tend to agree with both of those numbers. So you'll see me having extremely similar numbers on my SSG. Let's go to the next slide, Mark. Here's the SSG Plus tool that I'm using. I have knocked out 2016. That's when the tax problems occurred for this particular company. I also knocked off some very, very early numbers to get that trend line to lie fairly close to the data. I think I accomplished that pretty well. I'm having sales grow at around 10, earnings at around 11, margins very stable for the company, return on equity in the decent place, except for that year of 2016, which had that tax adjustment that would need to be made. And the debt is showing red on the tool, but remember, not all red is really red. And with debt at around 7%, that's certainly manageable debt for any company, this one included. Next slide, Mark. I'm looking at the back right now. I've kind of X'd out the 2016 numbers as being not representative. If I were to actually go into the tool and adjust the 2016 numbers for the tax issues, I would have good numbers for 2016, but I find it just as easy now to strike them and use the rest of the data to draw my conclusions. I've decided an average high PE going forward of around 23 and a low PE going forward of around 16 would be nice. That adds up to 39. I'm sorry, 39, and that gives me a PE average very close to the one Mark's using. Mine's, I think, 19.5, and his is 18. I'm willing to take either one of those and use those for the analysis. I'm getting a good solid buy. Next slide, Mark. There is a pretty decent dividend, not an extreme dividend, but about a 1.5 dividend coming from the company. And best case scenario, maybe 17.5%. Average case scenario, that's par, maybe 14%. I like to say to myself, I'll probably, if everything goes the way my analyst goes, I'll probably make somewhere between 14 and 17.5 if I were to sell it around 5 years from now. A good solid buy. I don't see any red flags for the company. And I'm going to suggest we put a holding of Forward Air in the portfolio.
All right, full speed ahead. That's what we'll do. Okay, now we'll switch gears and go to flowers and candy. I hope Herb, you're You haven't been bad lately and had to resort to the flowers delivered for your lovely wife, but
No, not at all. Actually, I've been hearing a lot of marketing on these, and so that's why I thought I'd look at it. Actually, you know, it should have been brought forward about 3 or 4 months ago, but it's a great little company that is in the mid cap. They sell gourmet food and gift baskets. They are, you dial 1-800-Flowers and you can have almost anything delivered anywhere, from popcorn to chocolate covered strawberries, which is a real benefit to be able to want to do that. So it's amazing how much, you know, they work with a lot of different companies, you know, in cheese and popcorn and candy and flowers. And they also are delivering flowers to different flower shops. So, you know, they have a strong balance sheet, they have a strong free cash flow, and they're a leader in mobile and social channels. So I would expect that this company is positioned itself to continue to grow with the millennials, because they like to go with the social channels and you know, Facebook and being able to order things right online, you know, using Amazon and gift cards and things like that. So you know, a number of years ago, I had chocolate covered strawberries delivered to me at a Boy Scout outing for my birthday from my daughter, and it came in. They were well taken care of and very cold and ready to be eaten immediately. So next slide. So this is their stock selection guide. As you can see, they flattened out on their sales a little bit, but now they're starting to come back. Some of this is to do with the timing of Easter. And so when you start looking at that, you're going to see that they do fluctuate. And as you can see, their price bars are going up to the top. And they've done a lot of growth here in the last 3 or 4 months. So I have historical sales at 6.9. I like to do my earnings per share no more than the rest of the, you know, what the sales are. So my earnings per share is 6.9 also. They do have some debt, and but they seem to be managing that, and that their pre-tax profit on sales are 3.6%, and the return on equity is 11%. So next slide. So this stock is ranked to outperform the broader market average for the next 6 to 12 months. But, you know, long-term appreciation, this is kind of a short-term buy, and I think that even that is going to go even farther than that. Their current price is 19. As you can see, their current PE is 38, which is higher than the average. So it's one of those companies that you want to be very cautious about what you're going to do and how you do it. They also, the stock trades well within the target price. However, Flowers earns unfavorable marks for safety and price stability. Subscribers with long-term horizon can probably find more suitable choices elsewhere. That was in May. So I think that this is a company that is, it's been on my hit list, and I missed when it went down to $10 a share, and I should have jumped on it at that time. Next slide. So as you can see that I have the high estimated earnings per share of 96. I'm doing my average PE of 23. So my forecasted price is 26. Actually puts it in the hold range, and it, but it still is price appreciation potential of 34.6%. Next slide. So Mark's chronicle here is showing that it's it really went right up, you know, in February. It took a major jump and then continued to climb. Now it's really doing back. Yeah, Mark?
Not to interrupt her, but I thought as I was just kind of scrolling through it, this is an excellent example of something we talked about during that cognizant session, where if you've got a stock that's in an upward trend, you know, that red line crossing over the blue, and you get that price gap, it really can be kind of a catapult. And that's what you were just talking about. A few months ago, you were looking at it, and it really did kind of launch. And it's fairly recently, it's come back from 22 down into the 19 range. So it is actually back kind of at that potential think of it as a short-term buy, but I thought it was kind of neat to show that catapult that we talked about with a couple of the other companies we case studied recently.
Yeah, it's an interesting study, and like I say, I had it on my hit list. But you know, when life gets in the way and you don't go back and follow into one of these stocks like this, and you should be, that's what happens when you don't get there. Oh, next slide, I think.
No, that's it. That's your last slide.
Okay. Thank you.
Okay, thank you, Herb. Yeah, we show, with the uptick in sales they've seen recently and decent business prospects, we still are looking at a 7% return, even though those prices were a little bit high versus where they had been not so long ago. So with that, let's go and talk about lasers with Cy.
All right, thank you, Mark. Again, I am presenting 2.6 this month. You can see that the historical chart shows very consistent sales growth and somewhat erratic earnings and pre-tax profit because of the sorts of business that it's in, which actually has been classified as a, I believe, precision instrument company. And interestingly enough, at least the closest analog or comparison that we have in the portfolio, and sometimes we mention, is IPG Photonics, which is in the semiconductor related industry. It's not in the same industry as 2.6, and they do different sorts of things with lasers. But part of the reason I find that interesting is I believe the precision instrument side, and why it's in that industry by value line and by manifest, is that they use lasers to make semiconductors and the substrates that semiconductors are built on. Although, as I'll talk about, they're looking to move into other areas, and that's by far not their only area. The reason I mentioned that, though, is that explains some of the cyclicality that you see in historical earnings, although certainly in recent years it's moving in the right direction. The key thing that shows that it's not overly cyclical for a company that we would normally think of is, again, the sales line is quite consistent. True business cycle-driven cyclical companies, the sales bounce along with the earnings and pre-tax profits. So next slide. Again, I settled on this company by a little bit of a roundabout way, but ultimately the way that I settled on 2.6 again this month was by starting with the roundtable portfolio, ranked by par, and took a look at the companies. And interestingly, unlike when I first found 2.6 back in November of last year, you notice there's quite a few high quality companies, that being indicated by the blue quality column in this, that also have yellow pars or relatively high pars. That was not the case in November, which is why I settled on 2.6 in a screen. But what's interesting is that MKS Instruments, which is an industry partner with 2.6, or an industry companion, is sitting there, and they track each other on a lot of the various metrics very closely, although they are in different, they do different things. MKS is not a laser instrument company. They are in the same industry, and they have very similar metrics, as you can see, and projections. The one caution that I would go ahead and point out for 2.6 is the financial strength. I think that may be somewhat due to the pending merger and debt levels there, but they do have a plan to pay down the merger debt, again, as we'll see a little bit. Next slide. I went ahead and rather than doing an industry, a quick industry study, which again would pop up both 2.6 and MKS Instruments, I just took a look at the Chronicles, which this is, Ken used it in his presentation for forward air, and you see both chronicles show quality fairly steady, maybe a tiny tick down in both instances as sales projections move downward slightly with each, and both are relatively high return, although notice 2.6, and one of the reasons I settled on 2.6 as opposed to looking closer at MKS instruments is that it is actually at the 5-year high for both its absolute par by manifest, but also if you can see, it's just a tiny line right above that last green line, but that's the relative par, which is relative to the market, and it also is at a 5-year high. So both of those I thought were good price indicators or potential return indicators for 2.6. Next slide. The company, you can read, I won't read it for you. I have presented it 4 times. This is the 4th time in the last, about 7 or 8 months. So it's not brand new to our regular folks, but they deal with engineered materials and light, specifically focus light in the form of laser in a number of different capacities, and we'll look a little closer at those as we go through the slides. Next slide. 2.6, the name came from the periodic table of elements. You could see zinc and cadmium, I believe, and then the 6 groups, which were the actual components that made up the first semiconductor base that they used, and that's why they chose the name. You could see that it's quite geographically diverse, somewhat highest concentration in North America, but pretty much spread throughout the rest of the world. The three segments they operate in, again, pretty diverse, and then their markets are optical communications is their biggest market now, and may remain their largest market going forward, but that will probably shrink somewhat as we see. Also notice it's worldwide and quite diversified by country as well. Next slide. Here's the big thing with 2.6 and has been the major factor since the second time I presented the company, and that is they have a pending merger with Finisar, which is also a laser company with an emphasis on optical uses for laser and 3D sensing, which if you wonder what 3D sensing is, notice it mentions automotive applications. There's a number of things 3D sensing is used, but probably the most widely known, perhaps to most of us, is used in automobiles for self-driving capability, both for looking at lane changes and warnings and so forth, but for parking, the cars that self-park and that sort of thing. They use 3D sensing technology to do that. Next slide. This is a slide that I have used before from 2.6's corporate presentation. I'd encourage you to go to the site and take a look at it, except they have expanded it to cover 20 years over the last 10 years that they used to show. What's important to me about this slide is that management has a record of successfully acquiring related businesses, integrating them, and growing. And that's what the Finisar acquisition hopefully will do. Next slide. Again, this is just the pro forma. It will roughly double the size of the company from kind of a, as Ken called it, kind of a small, medium-sized company into a more medium-sized company. Finisar or 2.6 is not a small company now. It's a little bit larger than that, but will be a little bit larger with Finisar. It will roughly double, and they'll increase their number of locations. Next slide. This chart is a new chart to my presentation as well as to the 2.6 presentations, but I think it shows what their strategy, both internally, but especially with the Finisar application, is that you can see what they call disruptive trends: electric vehicles, 3D sensing, cloud services, and the like. 3D sensing being a major part of that. And they're looking at their markets growing at about 16% currently, and projected over the next 3 to 4 years to grow at 20% compound rate of return. So it actually gives a tremendous opportunity to increase their revenue growth rate in the future. Next slide. And here are the details as to where that past chart just came from. And I kept mentioning the 3D sensing because that is a major area that they are emphasizing, both internally as well as with the merger. And that's the left-hand column there. Notice they are projecting a 60% compound growth rate in that area. The other one, the terrestrial, submarine, and wireless optical, that's a data center product that they have. And then also notice they're in electric vehicles as well. All of those industries are expected to grow faster than the current company is growing going forward. Next slide. This is just a little bit more detail on the 3D sensing. The other major application of 3D sensing and this LiDAR technology is facial recognition software. And one of their major companies or customers is Apple Computer. And I thought this, yeah, the iPhone is just the tip of the iceberg. I was going to say, I think this slide mentions Apple, but it's not simply Apple. It is smartphones generally, but iPhone is one of the major applications of their products. Next slide. And then just the company expects both to be able to increase sales growth going forward, not just by combining the companies, but actually increasing the rate of sales growth because of the synergies and the combined markets and the markets they're moving into. They also intend to cut costs and increase profit margins. And here's specifically how they plan to do it: by combining the two companies, both their supply chains as well as research and development, just the overhead costs, the general administration, and the marketing. Next slide. And this is my judgments and bottom line. I chose to continue to use a 12% sales growth. As you can see from previous slides, that could be subject to pleasant surprises. Also, that's a little bit below the manifest consensus analyst rate. That's closer to 14. Same thing on net margin. I have projected margin to increase, but not as much as both the company sees as potential, as well as the manifest potential consensus margin. Interestingly, though, I continue to use a 22 PE forecast, which seems reasonable to me based on growth and history. Manifest consensus is a little bit lower. So that accounts for why my projected annual return of 14%, which is still very healthy, as you can see, still about 5.5 points above my par, but not in the yellow. But my lower sales and lower margins, even with a slightly higher PE, comes out with a little bit more conservative potential return going forward. I think Value Line kind of sums it up best and also explains some of this difference in range, if you will, between the default manifest projections and my projections. Part of it is, of course, awaiting the merger and see exactly how that comes into play. But Value Line over the next 12 months projects a timeliness of just 4 for 2.6, but long-term has them in the 15 or higher percent long-term projection, and that's of course without the merger, because Value Line doesn't take mergers into account. So it's there's some near-term questions, but the long-term potential for the company appears to be very solid. And so again, I'm adding another $1,000 of 2.6.
All right. Well, thank you, Cy. My thoughts go to, we discover these kind of opportunities as all of us go around the country teaching and learning from local people. The people of Pittsburgh brought us 2.6 many years ago, and we're happy they did that. Herb Lemkool brought us Ionis Pharma a few months ago, and that's doing very well. So right in your backyard or your front yard, as we were saying during the green room, they can come to you. All right. Looks like I've got a few minutes here. It's 9:30. I'll try to keep it brisk and short. What you're looking at here is a quick screen. I am screening by quality. I want quality to be excellent, so anything above 80. Foot Locker actually got adjusted down in the middle of my work, and I didn't bother to throw them out. So you're looking at 16 companies, our Sweet 16 for this month, that have excellent quality. The second criteria that I wanted to look at, and we're going to talk about in detail, is owner's return on capital. Ranging from PetMed Express up at the top, that is my selection. PetMed is the highest owner's return on capital on the chart with an excellent quality rating, a decent return forecast, much like Cy was talking about for 2.6. And they're also in that oversold range with a RSI, relative strength index, down around 20. They are very close to their 52-week low. They're sitting within a couple percentage points of their 52-week low. Value Line likes them, 21% for their long-term total return forecast. And you can see that versus the fair value expectations of both Morningstar and the analyst consensus, that these are basically, they've got red potentially for sale tags hanging off of them. Some of the other companies you've heard about here tonight or in recent months are at the top of this chart too, but I'm not going to go any further than number one. That one's good for me for right now. Let's talk a little bit about return on owner's capital. Many of you have sent me emails asking about it. It basically grows out of some work done analyzing the work of, well, Kim Butcher for one, but people who follow the capital characteristics, return on capital for companies, and a lot of people like Joel Greenblatt, who is quoted here in how he thinks about investing. He's a very successful investor, and we'll be talking much more about him, but this is the definition of return on owner's capital that we are currently using. It is subject to change. This is a work in progress, but people use different flavors of things. I'm going to tell you the ones that I've settled in on, and it comes back to, again, everything that you do on a stock selection guide to generate an earnings per share forecast and then adjust it to pre-tax conditions is exactly what we're talking about. So a 5-year forecast, just like we do with a stock selection guide, to determine the pre-tax income, and then comparing that by dividing it versus the stock price paid for the investment. And then we also do something which really isn't done extremely in a detailed way on a stock selection guide, is consider the actual impact of the long-term debt. Again, that's all part of the total capital picture, and then also cash on hand. And in the case of the company we're talking about here tonight, when you're looking about 5 years out, you're talking about an earnings of about $3. Okay, stock price of 15. Okay, no long-term debt, so nothing for long-term debt, and they actually have $5 in cash. So 3 divided by 10, just rough numbers to give you a feel for this. That cash position has actually boosted that return, thinking as an owner of the company. And now Joel Greenblatt goes into and talks about how, thinking about any investment, he thinks about, what if I own the whole thing and I basically receive the earnings, receive the cash flow, receive that kind of stuff? when do the numbers start looking respectable? And much like the stuff that we do with, if you're going out and trying to buy a house to rent to renters, you would be able to come up with a number, and that number is going to be somewhere in that 8, 9, 10% range on an annual basis. The annual yield, if you want to think of it that way, or annual return on your original investment. And obviously it's impacted by the size of the mortgage you might have to take out if you're not paying cash for it, and just kind of the way you think through this whole thing. So we actually have cranked that out for all of the companies in the database. We'll be doing more on this subject, but this kind of lays it out for you. The pre-tax income in that 5th year out, you're literally thinking of that as an average year for the next 10 years. And keep in mind, these guys talk about owning a company as if the stock market were closed for 5 or even 10 years. That's the kind of mindset you want to be in. And it starts to do some fairly fascinating thing. It does everything that the stock selection guide does, but it also accommodates and encapsulates the debt and the cash position of the company. Okay, just as a reminder, we're talking about PetMed Express. This is a mail order for pets, a pharmacy mail order for pets, and a pretty good situation, pretty good chunk of the $72 billion pet market. And I would draw your attention to the fact that the area that is growing the most is right down the middle of the slide here from investor relations. Everybody else is flat to negative on the other aspects of pet ownership. But much like the human side of the business, the medical expenses are increasing at the highest rate. Here's a look at the company using the visual analysis and a little more extended version of some of the stuff that we look at normally. You can see that the sales trend has been fairly positive. The earnings were fairly flat for a while, but they have been improving, and they're projected to inch up a little bit. So we're talking about a company trading for about $15 a share that is virtually almost a $300 million company, growing at 4.5%. That 4.5% is the slope of that dotted red line that you can see on the business model analysis. So we are talking about a company that is projected to be a $350 million company 5 years from now. The projected net margin is 17.2. Again, that makes some sense based on this picture. And simply the math, value line checks in at about 17%, so we'll accept that. Projected shares outstanding have actually been fairly flat, right around 20. So we're talking about a company with earnings in the $3 range, PE ratio somewhere in the low teens. Again, looking at this picture, something that you can rationalize and justify. So a 13.6 PE. So we're talking about a company that is currently trading at 15 that could be projected to trade at 40 in 5 years. With a 2.4% dividend, we are talking about a 23-24% projected annual return situation under those set of assumptions. Now, they have no debt. They happen to have $101 million of cash on hand. That checks out to be about $5 a share. That's what actually ratchets this number up and triggers them on our search for special situations to invest in. They don't have any interest, so we can't check the interest rate. Again, that relative strength index is down around 23. That is compelling. And again, the worst case or low case scenario at value line still kicks out at 25% return. So this, again, is the type of situation that we've talked about a little bit in trying to invest like Buffett in the early years. And it's a deeper value situation, a little bit different than we sometimes do, but some fairly interesting stuff. Over the last year, you can see that the stock price has been sliding, but if they do stabilize and they basically fight back against some of the competition that they have, it's a brutal business. You can see that there have been 2 oversold instances. The one on the left, shown here by this big arrow on the left, is basically just proving that this stuff doesn't always work the way we would hope. This was an oversold situation in the price range of about 27, and that did not stop the stock price from dropping down to 15, where we once again have a situation where it's potentially oversold. So here's the analysis. You can read the words. This is the closing paragraph from Value Line. Again, it's not a timely situation. They're under some fairly vicious competition, but again, with a long-term perspective, financially strong, no debt, $5 a share in cash, pretty interesting situation in all, and I actually included a couple pictures of our pet Titan. You've heard of Titan a few times on this broadcast. I mean, how can you turn down that picture on the upper right there? So with that, let's go ahead and do the poll, Ken. Ken, are you still there? Or are you you're dialing your broker to order some PetMed Express?
Yes, I am. Can you hear me now, Mark?
Yes.
Okay, I had myself muted. All right. There's the poll, folks. All you have to do is use your mouse or your finger or whatever you need to do to interact with the screen and choose one of these stocks. We'll keep the poll open till we get about 85% of our folks voting here.
And for those of you out there scratching your head while you're voting, we will be having much more detailed discussions about this return on owner's capital concept, if for no other reason, for screening type concepts.
We'd love to get about 8 or 9 more of you voting here if we could, to push it up to about 85%. I'm going to count 10 in my mind here and then close the poll. If you've never done this before, just take a stab at which one you think you might want to add to the portfolio. Then you can find out how well you've done a year from now, okay?
It's no pressure.
No pressure. Close the poll and let's share the results. And it looks like we're going to add a second holding of Forward Air. 2.6 and PetMed, very close together. Herb, they listen to your pitch. They don't especially like flowers, and we actually had a fairly high none of the above in this particular session tonight.
Okay, well,
yeah, we had, yeah.
Fair.
Well, you know, I'm not totally embarrassed because I know Mark's been there too.
Oh, touche.
So, Mark, we have a number of technical questions, and a lot of these are asking for opinions about various things. So let's try to answer just a few of the questions that we have. Mark, do you want to close the session down and talk about coming attractions before we get into questions?
Yeah, let's just go ahead and point out that we are going to be in a number of areas, including Oklahoma City, and I'm getting a little bit of air noise from somebody. It could be you, Ken. Might want to adjust your microphone. And I do want to point out that in a couple of months, Kim Butcher, who, by the way, she sent greetings to us tonight. She's actually on a plane, much like our buddy Hugh. Hugh said he's probably going to be here next week or next month. So everybody cross your fingers on that. But Kim and Ken and Si are going to be in Atlanta on the 24th. So if you're within striking distance of Atlanta, that could be a pretty cool thing. And Ken and I are starting to pick up some more opportunities. We're going to be putting together some visits right around Halloween. Ken doesn't know this yet, but we're going to be in a few places talking about our small company discovery.
All right.
On that time frame. And we are now getting demanded/threatened to do that. So we'll cooperate on that one. All right. I think that's all for now. I think I will shut down and we'll let the questions roll with it not being recorded. So again, thanks guys for your contributions here tonight, and really appreciate it.
Okay, our first question is from Michael, and he wants to know, does Forward Air